Good morning. Revenue is the most important financial indicator of any enterprise. Every other financial indicator is derived from this figure, and this makes revenue a very paramount important indicator. In India, we have two accounting standards which deal with revenue: AS7 construction contracts and AS9 revenue recognition. Until recently, both of these standards were almost in line with the corresponding international practices. But in the wake of the issue of the new IFRS 15, revenue from contracts with customers, revenue recognition criteria globally has undergone a few changes. This presentation is an attempt to outline these issues in brief. First of all, what is revenue? Generally, by the term revenue, we construe to mean the total of the sales and other income of an enterprise. Putting it technically, AS9 defines revenue as the gross inflow of cash, receivables, and other consideration arising from sale of goods and from rendering of services and from use by others of enterprise resources. Typically, these are the three sources from which AS9 recognizes revenue. So the big question is, when should revenue be recorded? Essentially, there are two basic conditions for recognizing revenue. The first one is, it should be able to be reliably measured. Unless revenue is reliably measurable, we can't recognize it. The second condition is that it should not be unreasonable to expect ultimate collection of revenue. If it is unreasonable to expect ultimate collection of revenue, we have to postpone revenue recognition. Keeping these basic conditions in mind, let us see what is the revenue recognition criteria for each of the three sources of revenue. The first one being the sale of goods. So, when to recognize revenue from sale of goods? We should recognize revenue from sale of goods when sale happens. Well, when does sale happen? Sale happens when the seller stops becoming the owner and the buyer becomes the owner. Or in other words, when ownership is transferred. When ownership is transferred, usually, in most cases, significant risks and rewards of ownership are also transferred. But there are exceptions. For example, A has sold goods to B. So ownership is transferred from A to B. But they entered into an agreement where, unless the goods are safely delivered to B, any risk of loss in goods is to be borne by A. Here, significant risks and rewards of ownership are transferred only on safe delivery of goods. That's why AS9 requires that revenue from sale of goods can be recognized on ownership transfer or when the significant risks and rewards are transferred. The second condition is the seller should not retain any effective control over the goods as if he is an owner. The second stream of revenue is from rendering of services. Here, the issue is a service provider, when he is providing service, he earns revenue as the service is being performed. So, to recognize revenue, we should know when is the service performed and how much is it. When we know the stage of performance of a service, we can ascertain how much revenue to be recognized. Here, the standard prescribes two methods by which we can ascertain how to recognize revenue. The first one being the proportionate completion method. In the proportionate completion method, you calculate the proportion of the service we have completed so that we can recognize that much of revenue. The second one is a completed service contract method, in which these are applied to services where until all the activities of services are finished, we can't recognize revenue. So here revenue is recognized once the service provision is over. The third one, the revenue recognition standard identifies, is the use by others of enterprise resources. The standard identifies three such cases. When others use the money of the entity earns interest. Interest should be recognized on a time proportion basis. The second one is royalties. When another entity uses our intellectual property, goodwill, etc., we earn royalties, and royalties are to be recognized on an accrual basis based on the agreement. The third one is dividends. When an entity invests in another's equity, it earns dividends, and dividends should be recognized when the right to receive is established. So, having seen all the three streams of revenue and how to recognize them, this is briefly what AS9 covers. Now let's move to the next revenue-based standard, AS7 construction contracts. The main issue in AS7 construction contracts is construction contracts typically are long-term in nature. Their commencement and completion fall in different accounting periods. So, with lack of standardized revenue recognition principles, it may lead to distortion of revenue, and revenue may be recognized too early or too late. So before going into what does the standard speak, let us see how it defines a construction contract. AS7 defines a construction contract as a contract specifically negotiated for the construction of an asset or a combination of assets, and it includes any service which is directly related to construction of an asset. AS7 also includes destruction of an asset or the restoration of the environment surrounding an asset into the ambit of construction contract. So now, what actually comprises contract revenue? In a construction contract, typically the contract revenue comprises the following: the basic contract price, obviously, and the second one is the variations that come up during the progress of the contract. There are also claims which the contractor puts upon, and when accepted, it leads to increase in revenue. And there are cost escalation clauses by which, in case of fixed contracts, the revenue can be increased. And there are also penalties which the customer may impose, and this may lead to reduction in revenue. This is about contract revenue. Now let us see what comprise contract costs. There are three types of contract costs, like in any other cost. The first one being the direct costs that are directly related to the construction contract. For example, materials. There is a construction contract A for which we use some materials. So this is a cost directly related to the contract. The other one, the second one, is a cost that is attributable to the contract. For example, an entity has 5 construction contracts A, B, C, D, and E, and it operates a small machine for all of them. Depreciation on the machine is allocated or attributed to each one based on a reasonable basis. This can be an example for a cost attributable to the contract. The third type of cost is a cost which is specifically charged to the customer based on the contract agreement. For example, the contractor may agree that the development cost of a particular project be charged completely to a particular customer. So having seen what is a construction contract, what is contract revenue, and what is contract cost, let us see what does the standard speak about recognition of contract revenue and expense. As we have already discussed, in services, revenue is incurred and revenue is earned and expenses are incurred as the construction is progressing. So as the construction is progressing, this means we should know the stage of completion of the contract. Now, so how to determine stage of completion of contract? Here, for stage of completion, there is only 3 methods which the standard prescribes. The first one being the cost to cost method. Here, the contractor ascertains how much of the total contract cost is already incurred, and he recognizes that much of revenue. The second one is by survey of work performed. Like, he may call upon an independent surveyor, and based on the survey report, he may recognize revenue to the extent of the performance of the contract. The third one is by physical proportion of the work performed. Now, there may be cases where the total expected cost of the contract may exceed the total expected revenue from the contract. In other words, there may be an expected loss in the contract. So what to do when there is an expected loss in the contract? Owing to the concept of prudence, the standard says expected loss in the contract should be recognized immediately, irrespective of the commencement of the work, irrespective of the stage of completion of the contract and irrespective of the profit from other contracts. So now, having seen both the construction contract, both the standards, revenue recognition and construction contracts, let us compare them with IFRS, the global reporting language. The corresponding standard, international standard for IAS 7 is IAS 11 construction contracts. They are typically identical. The corresponding standard for AS 9 revenue is IAS 18. IAS 18, there are typically two standard differences. As we have already discussed, in case of services, AS 9 prescribes two methods for determining the stage of completion: the proportionate completion method and the completed service contract method. The second one is not recognized in IAS 18. The another difference in the standards is IAS 18 speaks something about revenue swaps. It's something like barter. This concept is not endorsed in our standard AS 9. Going forward, IAS 18 and IAS 11 are now soon going to be part of history because of the next big thing on the game, IFRS 15, revenue from contracts with customers. This standard, the new one, was issued on 28 May 2014, and this one replaces IAS 18, IAS 11, and many other revenue recognition literature globally. This one is applied for reporting periods beginning on or after 1st January 2017, and this means a dramatic change. This may lead to early recognition of revenue in some entities, and most entities are going to be ready to get a dramatic change. So what does IFRS 15 speak about? Briefly putting it, there is a core principle in IFRS 15. The principle is very simple. What is revenue? An entity enters into a contract with a customer. When it enters into a contract with a customer, it is entitled to some rights and it is responsible for some obligations. So it has performance obligations 1, 2, 3, 4 in the contract. As it keeps satisfying each of the performance obligations, it gets revenue, it gets consideration. So IFRS 15 says, recognize revenue to depict transfer of promised goods or services to the customer in an amount that reflects consideration to which an entity expects to be entitled in exchange for those goods or services. Putting it simply, IFRS 15 specifies what is called a 5-step model framework. This 5-step model framework, once we go through, we can recognize revenue. The first one is identify the contract with the customer. Once we know the contract with the customer, we have to identify the performance obligations in the contract. Say we have 5 obligations in the contract. Performance obligation 1, 2, 3, 4, and 5. Then we have to determine the transaction price. Now, we know what's the contract, we know what obligations we have in the contract, and we know a transaction price. Now, our job is to allocate this transaction price to each of the performance obligations. Then, once we have allocated, as the entity keeps on satisfying each performance obligation, it keeps on earning or recognizing components of the transaction price as revenue. This is briefly what IFRS 15 speaks about. This means, as we have already discussed, revenue is a very, very important financial indicator. And when the basic recognition criteria of revenue changes, entities grow very, very carefully because each and every analyzer of financial statement analyze revenue very, very closely. So, IFRS 15 brings in a very significant change. So, entities, it's not exaggerating if I say entities arrange their contracts, entities draft their contracts differently from now on based on this program. So it may not be wrong if I say that IFRS 15 impact extends beyond the finance function. Because of this, entities must gear up for building strong foundations for the future. With this amount of change happening, I feel this requires a comprehensive revision in the accounting principles in India as well. talking about this much of change and this much of transition happening, I would like to sign off with a very famous quote on change. It is not the strongest of species to survive, nor the most intelligent, but the one who is most adaptable to change. Thank you.